Welcome to Gold Bank Insider.
Good to be here.
So, I have a set of numbers on the guest today that honestly look like a typo. I actually had to double-check the decimal placement before we turned the mics on.
Yeah, I know exactly which numbers you are talking about. It is the kind of report that makes you tap the calculator screen a few times just to be absolutely sure you are reading it right.
Right. We are looking at a movement in the platinum sector, specifically coming out of South Africa, that has direct implications for the UK market. And the headline here is just massive.
It is a 25-fold surge in half-year profits for Northam Platinum.
25-fold. I mean, that is 2,500%. Usually when I see a company report that kind of jump, my immediate thought is that, well, they sold off a subsidiary or they sold the office furniture.
Yeah, exactly.
It feels like a one-off accounting trick.
That is exactly the healthy skepticism you should have as an investor. You always look for the one-off item. But in this case, the answer is no. They didn't sell the furniture.
So no accounting magic.
None. What we are seeing here is a textbook case of specific market circumstances converging perfectly. You have record prices colliding with increased production.
Which is the dream scenario.
It really is. And it is a rare alignment that splits the overall market into very clear winners and very clear losers.
And that is the roadmap for what we are doing today. For those of you listening, we need to figure out how to get exposure to this sector without getting burned. Because, as we will see, not everyone is making 25 times their money.
No, definitely not.
So first, we are going to break down Northam's numbers to understand the actual mechanics of how this happened. Second, we need to look at the broader market forces. Specifically, that's supply and demand tension.
Right, the macro environment.
Exactly. And third, we're going to look at the specific winners and losers across the sector. Because there are some big names in the UK market that are actually struggling despite this entire boom.
And that distinction is vital. For anyone managing a portfolio, it is about understanding the difference between the commodity price moving and the actual company performance moving. They are not always the same thing.
They absolutely aren't. So let's start with the headline data. Northam Platinum's financial results for the 6 months ending the 31st of December.
Okay.
As we just said, profit is up 25-fold. But let's look at the revenue line. Revenue climbed 60% to 23.2 billion rand.
The revenue number is definitely the place to start unpacking this. A 60% jump in revenue is impressive, certainly, but 60% revenue growth usually does not translate into 2,500% profit growth.
Right. The math feels disconnected. I mean, if I get a 60% raise at my job, my bank account doesn't usually multiply by 25.
Sadly, no.
So how does that math actually work for a mining company?
It comes down to a concept called operational leverage. This is really the magic of the mining business model when things go right.
Let's break that down for the audience. What does operational leverage look like in practice here?
Think about the physical realities and the costs of running a deep-level mine in South Africa. You have these massive fixed costs. You have to ventilate the shafts constantly.
Right.
You have to pump out water. You have to run the elevators up and down. And you have a very large labor force to pay.
And those bills come due no matter what.
Exactly. You have to pay those bills whether you pull 1 ounce of platinum out of the ground or 10,000 ounces. The cost to just keep the lights on and keep the mine safe is roughly the same.
So your baseline expense is huge,
Right.
but it is effectively static.
Yes. So let's run a hypothetical. Let's say your cost to produce an ounce of metal is $1,000.
Okay.
If the market price is $1,001, you make exactly $1 of profit on that ounce. You're barely surviving.
You're scraping by.
But if the market price suddenly jumps to $2,000, your costs haven't changed. You are still paying the same amount to run the elevator and pump the water.
Because the mine doesn't know the platinum price went up.
Precisely. The rock doesn't care what the spot price is. So that extra $1,000 of price, it falls almost entirely to the bottom line. You haven't just doubled your profit. You have gone from making $1 to making $1,000.
Wow. Okay, that perfectly explains the multiplier effect.
That is operational leverage in action. When you cover your fixed costs, every extra dollar in price expands your margin disproportionately. And Northam hit this sweet spot perfectly. Their basket price increased by 53%.
I want to pause on that exact term, basket price. Because for a generalist investor in the UK, if they hear basket, they might think of a mutual fund or an ETF, but this is actually about the geology, isn't it?
It is entirely about the geology. In the Bushveld complex in South Africa, which is where these specific mines operate, you rarely find just one metal sitting there by itself.
You don't just dig a hole for platinum.
No. When you blast the rock and bring that ore to the surface and process it, you get a mix of metals. You get platinum, palladium, rhodium, gold, and a few trace others.
It is a package deal from the earth.
It is. So the basket price is the weighted average price they get for every ounce of that mixed metal they sell. It is a bit like selling a fruit basket.
Okay, I like that analogy.
Maybe the price of apples in the basket is steady, but if the price of avocados in the basket absolutely triples, the value of the whole basket goes up. In this specific case, the value of Northam's basket went up 53%.
That is a massive tailwind for the revenue.
Yeah.
But did they actually produce more metal, or was this entirely a price story?
That is the kicker. It was both. And that is why the leverage was so intensely powerful here. Refined metal output rose 3.7% to 467,818 ounces.
So they are physically digging more out of the ground.
Yes. And they are selling more. Metal sales jumped nearly 14%.
Wait, if production only rose roughly 4%, but sales jumped 14%, that implies they were drawing down some stored inventory to meet the demand.
That is exactly what it implies. They had inventory ready to go. So you have a company selling 14% more volume at a price that is 53% higher, with operating costs that are largely fixed.
That is the recipe. That is how you generate a 25-fold profit surge.
It is the perfect storm for profitability.
And the ultimate outcome for the shareholder holding Northam stock.
A record interim dividend. The board is taking that excess cash and handing it right back to the owners.
Which is the ideal scenario for anyone listening who holds the stock. But Northam is just one player. They are selling into a global market. We really need to zoom out and look at the broader PGM environment itself. What is happening with the metal to drive these prices so high?
Well, the spot platinum performance has been remarkable over the last year. The price basically more than doubled.
Doubling is a huge move for a mature industrial metal.
It is a massive move. We hit a record above $2,700 per ounce in late January.
What is driving that specifically? Is this just financial speculation, or is there a physical shortage?
It is a classic supply and demand squeeze, but it comes with a very specific policy twist. If we look at the supply side first, things are incredibly tight. Getting this metal out of the ground is difficult under normal circumstances.
Let alone in a deep-level environment.
Right. We just mentioned the deep-level mining in South Africa. It is extremely capital-intensive, it is physically dangerous, and you cannot just flip a switch to increase production. It takes years and billions of rand to sink a new shaft.
So the supply curve is inelastic. You can't just spawn more platinum tomorrow because the price went up today.
Exactly. The supply is constrained.
What about the demand side?
This is where the UK and European context becomes absolutely critical for investors. We are seeing rising investment demand, certainly people buying physical metal or ETFs, but the real structural story is the policy angle regarding the combustion engine.
You mean the EU ban, the 2035 ban on selling new petrol and diesel cars?
Correct. For a long time in the market, the prevailing narrative was that the internal combustion engine was essentially dead. And since platinum is primarily used in catalytic converters to clean up exhaust fumes, the assumption was that platinum demand was on a terminal decline.
Right. The logic is simple. If you don't have exhaust fumes because everyone is driving a battery EV, you don't need a catalytic converter.
Exactly. So the market was pricing in the slow death of the metal. But that narrative has shifted in a major way. The EU has adjusted its stance.
How so?
It is not that the 2035 ban is completely gone, but the implementation details, the synthetic fuel carve-outs, and the exceptions all suggest that the combustion engine and hybrid vehicles specifically are going to be around for a lot longer than those aggressive early forecasts predicted.
So it is effectively a stay of execution for the combustion engine.
In a practical sense, yes, and that changes the demand curve entirely. If we are going to be driving combustion engines and hybrids for another 15 or 20 years, the auto industry needs millions more catalytic converters than they previously modeled.
And every single one of those converters needs a coating of platinum or palladium to function.
Right, so you have a global market that had stubbornly priced in the death of the metal, suddenly waking up and realizing they need to reprice for an extended lifespan of demand. That sharp shift in expectations is what is driving the spot price up so aggressively.
Okay, so we have the macro backdrop clearly established.
Right.
We have constrained, inelastic supply meeting an extended revised demand curve.
Exactly.
Now, Let's get to the practical part for the listener holding a portfolio. The winners and the losers. We have already established Northam as the heavy hitter here.
Yes, Northam is the clear winner of what we call the pure play strategy. If you owned Northam, you had direct, unfiltered exposure to platinum price with very little corporate distraction.
But they aren't the only ones doing well in this environment. Let's talk about Valterra Platinum.
Valterra is another very strong performer right now. They have recently guided to a full-year profit, roughly doubling.
Which, after hearing 25-fold, sounds almost modest. But doubling your profit in a single year is usually a headline event in any other sector.
It is a massive win. It is a very strong signal to the market. And what really stands out with Valterra is the specific driver behind that doubled profit. Yes, they benefited from the higher basket prices, just like Northam, but they also explicitly cite cost actions in their guidance.
Cost actions, that is the classic corporate speak for cutting the fat, right?
Essentially, yes. They are managing their operational expenses aggressively. This is the other side of that operational leverage coin we talked about earlier.
How does that work?
Well, if you can keep your fixed costs flat or even actively lower them through efficiencies, while the revenue line is shooting straight up because of the spot price, you are widening your profit margin from both ends simultaneously.
It sounds like the absolute ideal scenario for a management team. You have the global market giving you a massive raise, and you are simultaneously tightening your belt internally.
Precisely. It really reinforces that core theme of leverage in the mining sector.
Who else is sitting in the winner's circle right now?
Zimplats is a great example to look at.
Zimplats. What is their specific story here?
Their story is mostly about timing and capital cycles. They are now positioned to resume dividends to their shareholders.
The word resume implies they had to stop paying them at some point.
They did, and they stopped because they have been going through a very long, very capital-intensive expansion program.
Right.
In the mining industry, you have these long periods where you spend huge amounts of money, what we call CapEx, or capital expenditure, to build infrastructure. You are digging new shafts, building processing plants, upgrading the power supply. During that build phase, you consume massive amounts of cash.
You're basically burying money in the ground, hoping to dig it back up later as profit.
That is a very literal way of putting it, but yes. And Zimplats is just coming out of that heavy spending phase. They are finishing their major expansion projects right as the platinum prices are hitting these record highs.
That is impeccable timing.
It really is. They are moving from a cash-consuming phase to a cash-generating payout phase right when the market is at its hottest.
So they have the new infrastructure ready just in time to capture the peak pricing.
Exactly. And this actually highlights a broader trend we are seeing across the sector right now. The clear winners are moving toward aggressive payouts. They are prioritizing cash returns to shareholders while the sun is shining.
So if you are a UK investor looking at this sector right now, the primary theme really is, show me the money.
It is. It is entirely about converting those high spot prices on the screen into actual dividends landing in your brokerage account. If a company can't do that right now, the market is going to punish them.
Which brings us to the flip side of the coin. And this is the crucial part for anyone listening. A high tide does not necessarily lift every single boat.
No, it doesn't.
Even with platinum sitting at $2,700 an ounce, there are major companies actively struggling. Let's talk about the losers in this environment.
And this is where the nuance of portfolio construction becomes absolutely essential.
Let's start with a name that is going to be very familiar to the UK audience. Johnson Matthey.
Right. They are a key name in the industrial value chain here in the UK.
But they are listed firmly in the loser column for this discussion. Why is that?
Because they sit on the exact opposite side of the table from the miners. Johnson Matthey is a chemicals and technology company, but functionally they are a massive user of PGMs. They buy the metal to manufacture the catalytic converters and other high-tech products.
So for a company like Northam, platinum is the product. But for Johnson Matthey, platinum is just a raw expense.
Exactly. It is an input cost for them. When the price of platinum doubles over 12 months, their cost of doing business skyrockets. And unless they can pass every single penny of that increased cost onto their automotive customers perfectly, which is incredibly hard to do, their profit margins get squeezed tight.
And their recent report noted that they actually took a reduced price on a sale.
Yes, they took a reduced price on their Catalyst Tech sale to Honeywell. In the commentary, they specifically cited weaker profitability and deferred projects.
Deferred projects. That phrasing usually means their clients are hesitating to pull the trigger on new orders.
That is the direct implication. It suggests that these extremely high commodity prices might be causing some demand destruction or at least serious hesitation further down the supply chain.
Because the car manufacturers don't want to lock in at peak prices either.
Exactly. So it is a negative read-through for the industrial side of the sector.
It is a zero-sum game, in a way.
Yeah.
High metal prices effectively transfer wealth away from the companies that buy the metal, straight to the companies that mine the metal.
That is a very accurate way to put it. And Johnson Matthey is currently feeling the severe friction of that wealth transfer.
Okay, so the lesson there is to be careful with the industrial users. But let's look at another actual miner, Sibanye-Stillwater. They are a massive player in the mining space. Why are they sitting in the loser column alongside the users?
With Sibanye, this is much more about sentiment and expectation management than pure mechanics. In their updates, they heavily flagged near-term PGM price volatility.
Volatility.
Yeah.
But we just established prices are way up.
Prices are up, yes, but they're swinging wildly day to day. And institutional investors generally despise uncertainty.
They want a straight line up.
Of course.
Mhm.
Even if the overall trend is upward, if a management team comes out and explicitly says, look, things are bouncing around wildly, the market is chaotic, and we really aren't sure where this settles, it completely dampens investor confidence.
So it is less about their hard production numbers and more about the predictability of those future numbers.
It is. If the market feels that the future earnings are opaque or unpredictable, they will automatically apply a risk discount to the stock price. They want a sure thing, a reliable dividend, not a roller coaster ride.
Which makes sense. And finally, perhaps the biggest name on the list today, and honestly maybe the most surprising loser, Anglo American.
A true giant of the mining industry globally.
And yet, they just posted a large loss.
A very large loss.
How does a multinational mining giant actually lose money when the core commodity we are talking about is sitting at an all-time high?
Because they do not just mine platinum. This is the harsh lesson of what we call the diversified miner. Anglo American is a sprawling conglomerate. They have their fingers in many different pies. They mine iron ore, they mine copper, and crucially for this story, they mine diamonds.
Through De Beers.
Through De Beers, yes. And while their platinum division might be absolutely printing money right now, the diamond business has been struggling profoundly. The market for rough diamonds has been very weak.
So they had to write that down.
They did. They had to take massive accounting write-downs on the value of De Beers.
So the massive gains happening in the platinum pocket are just being completely erased by the structural losses happening in the diamond pocket.
Exactly. The net result for the overall company is loss. And the subsequent action they took, they cut shareholder returns.
Ouch. That is the real sting for the retail investor.
It is painful. If you bought Anglo American shares thinking it was a safe, blue-chip, diversified way to get exposure to this platinum boom, you are walking away disappointed. You are seeing a dividend cut, while the Northam shareholders down the street are seeing record payouts.
It is a stark reminder that being diversified actually cuts both ways.
It really does. We are so trained to think of diversification as pure safety. You know, if one thing fails, the other thing saves you.
Right, don't put all your eggs in one basket.
Exactly. But in a raging bull market for one very specific commodity, corporate diversification acts like a heavy anchor.
The diversified drag.
The diversified drag holds the overall stock back from reflecting the peak pricing of its best performing asset.
So, bringing this all together, what does this mean for the UK investor listening right now? How should they be thinking about this influx of data?
If we synthesize all these moving parts, the Northam result really is the ultimate proof point for the sector. It proves exactly how quickly and violently platinum price spikes flow directly through to a pure-play miner's earnings and their dividends. The translation is almost instantaneous.
And regarding the policy signals we discussed.
The policy signals, specifically the shift in the EU ban implementation, are completely moving the macro narrative. The story of platinum's imminent demise was just premature.
The market got it wrong.
They got it wrong. The demand floor for the metal is much higher, and it stretches much further into the future than the market had priced in even a year ago.
So for the investor who is watching inflation-sensitive assets, or specifically looking at these mining stocks,
the primary focus right now has to be on balance sheet strength and immediate cash returns. But even more importantly than that, it is about the specific corporate vehicle you choose for your exposure.
the structure of the company matters just as much as the spot price of the metal.
It does. It is entirely about spotting the difference between pure operational leverage, like we clearly saw with Northam, and diversified drag like we saw dragging down Anglo-American.
That distinction seems to be the absolute key to navigating this current environment safely. You have to know exactly what is inside the corporate basket you are buying.
It is the fundamental lesson of this reporting season, without a doubt.
And just a final thought for you to mull over as we wrap up. If demand stays higher for longer, the next bottleneck might not just be the mines, but the recycling constraints. How much of this metal can we actually pull out of old scrapyard converters to feed the new ones? Something to keep an eye on.
Absolutely.
We will leave it there. A 25-fold increase that serves as a massive reminder to always check the underlying details of your portfolio. Thanks for listening to Gold Bank Insider. Stay sharp.